For most people, a home is the biggest purchase that you will ever make. It's rare that people have cash on hand to pay for a home, so most people pursue a mortgage. Let's cover mortgage basics and all of the types of mortgage loans so that you can make the best decision for your situation. First, what's a mortgage? A mortgage is a financial instrument that people use to borrow money to buy a home and spread the cost of repaying it out over time. It allows someone buying a home to live in it while the loan is being repaid. A lender agrees to give money to a borrower, and the two work out a payment plan. The lender does this for two reasons. One, there's interest on the loan, which means that the borrower ends up paying more than originally borrowed, sometimes a lot more. And two, if the borrower doesn't stick to the repayment plan, the lender can then take the home. There are many different kinds of mortgages. Before deciding which one is right for you, let's go over some basic mortgage terms. Down payment. This is an amount of money that the borrower has to put down before getting a loan, typically expressed as a percent of a home's value. For example, if a home costs $500,000, a 20% down payment would be $100,000. If you put down less than 20%, you will usually be required to purchase a private mortgage insurance, which will add to the cost of your loan. Principal. The amount you need to borrow, which is the cost of the home less whatever you pay as a down payment. Interest. The cost of borrowing money in the form of a percentage added to the principal. Interest can end up adding a lot to the total cost of paying off your mortgage, depending on the type of mortgage you seek. So, which kind of mortgage is right for you? Let's take a look. We'll start with the 30-year fixed rate. This is by far the most common type of mortgage. You get a set interest rate that doesn't change for the life of the loan, and it's paid off over the course of 30 years. There are two big benefits to the 30-year fixed rate. One is the stability of an unchanging interest rate, which means that your payments will be the same each month. The other is the long repayment period, which means that your monthly payment will be more manageable than it would be if you went with a shorter period. The downside is that the long repayment plan means that you will end up paying more in interest over the life of the loan. If you think that you can handle larger payments, you may want to consider a 15-year fixed rate. The 15-year fixed rate mortgage also has an interest rate that doesn't change. You just have to pay it off in half of the time. Now, the upside to a 15-year fixed rate is that you will save money by paying less in interest. It can be a good idea if you don't have a lot of extra cash at the time that you're buying a home, but maybe you expect to have more soon, such as you're starting a new job. The cost is that your monthly payments will be higher and will leave you with less money for other household expenses. Not all mortgages have fixed rates. Some are adjustable rate mortgages. An adjustable rate mortgage will have a set period where the interest rate is fixed. Then the interest rate can fluctuate for the course of the loan. Usually the fixed rate period will be lower than what you could find with a fixed rate loan. Adjustable rate mortgages will often be named with two numbers. The first will tell you how long the fixed rate period lasts. The second will tell you how frequently it can change after that. A 5-to-1 would have a 5-year fixed rate period, then may be subject to change once a year after that. Adjustable rate mortgages can be good for people who only plan to stay in their homes for a brief period. You could sell the home before the fixed rate period ends, and if the home is increased in value, you could make money. But not all homes will appreciate quickly enough. The value of your home could decline, and once the rates are no longer fixed, you are subject to changing rates that could end up costing you more than you would pay with a fixed rate mortgage. The types of mortgages we've discussed are sometimes called conventional mortgages. There are other types of mortgages that are also offered through private lenders, but are backed by the US government. Not everyone will be eligible for these kinds of mortgages, but if you are, there can be advantages. First up are Federal Housing Administration loans. FHA loans are available to people who don't have good credit, and they call for a down payment as low as 3.5%. The downside is that you have to buy FHA mortgage insurance. If you have good credit and can afford a bigger down payment, a conventional mortgage may be a better deal. Next are Veterans Administration loans. VA loans are for people who have served in the US military. Like FHA loans, VA loans are available to people with poor credit, and they don't require any down payment at all. They do, however, usually require a one-time fee upfront, and there are limits on the types of homes that they can be used for. Finally, there are US Department of Agriculture loans. USDA loans are for people looking to buy a home in a rural area because they're intended to encourage home ownership among those less well off. There are a lot of requirements about who is eligible to receive them and where they can be used. Check out our link below this video for an explanation of some of these regulations. Another type of unconventional mortgage is a jumbo mortgage. These are loans for larger amounts and are usually associated with more expensive homes. For 2020, a loan above $510,400 in most of the country is considered a jumbo mortgage. Lastly, interest-only mortgages offer what the name says, at least for the first 5 years of the loan. Your payment contains only interest as opposed to interest and principal. An interest-only mortgage might have a 30-year term, with the first 7 years of payments being only interest. These initial payments will be lower than what you would pay with a fixed rate mortgage, but once this period ends, your payments will be higher. This makes them advantageous for people who expect to be earning more in a few years than they are right now, or who have a large expense that is likely to go away in a few years, like paying for a child's education. On the other hand, because you have a period of time where you aren't paying down principal, you will end up paying more in interest and more over the life of the loan. We're eForms, the biggest online database of legal documents. For more info on mortgages, click the link below this video. And don't forget to subscribe for more weekly videos.